Are you ready to take control of your financial future, but don't know where to begin? If you're thinking about investing, but feel overwhelmed, you're not alone. The world of investing can be confusing, especially for beginners. But the good news is that it's never been easier to get started. In today's video, we'll cover the basics of investing in 2024, how to get started, what investment options are available, and how you can begin building wealth today. 1. Why invest? Before we dive into the how, let's talk about the why. Why should you invest your money instead of just saving it in a bank account? The answer lies in growth. Investing allows your money to work for you by earning interest, dividends, or increasing in value over time. With inflation eating away at savings in regular bank accounts, investing is the best way to beat inflation and build wealth over the long term. Even small amounts invested early on can grow exponentially, thanks to the power of compound interest. 2. Understand the basics of investing. Before you jump in, it's important to understand the basics. Investing is essentially putting your money into something that has the potential to grow over time, like stocks, bonds, real estate, or mutual funds. Stocks represent ownership in a company, while bonds are loans to companies or governments. Real estate involves investing in physical properties. Mutual funds and ETFs, exchange-traded funds, are collections of investments, which allow you to diversify your portfolio without having to pick individual stocks yourself. 3. Types of investments for beginners. So, what are the best types of investments for beginners? Here are a few to consider. Stocks. If you want to own a part of a company, stocks are a great option. They offer the potential for high returns, but they also come with higher risk. Bonds. Bonds are lower-risk investments that pay you interest over time. While the returns aren't as high as stocks, they are much safer. ETFs and mutual funds. These are great for beginners because they allow you to invest in a diversified portfolio. Instead of picking individual stocks, you invest in a collection of assets, which helps reduce risk. Real estate. Real estate can be a great long-term investment, but it requires more capital upfront. You can start small by investing in REITs, real estate investment trusts, which are a way to invest in property without owning it physically. 4. How much to invest? How much should you invest? The general rule is to start with what you're comfortable with and can afford to lose. For beginners, it's wise to start small and gradually increase your investments as you learn more. Ideally, you want to set aside at least 15 to 20% of your income for savings and investments. If you're really starting from scratch, begin by investing small amounts, $50 or $100 a month, and increase over time. The most important thing is to be consistent and disciplined. 5. Risk and reward. Investing always involves risk, and it's important to understand that risk and reward go hand in hand. Generally, the higher the potential return, the higher the risk. If you're just starting out, it's smart to focus on lower-risk investments like bonds, ETFs, or index funds, and gradually move into riskier assets like individual stocks as you become more experienced. A good way to manage risk is by diversifying your investments. This means spreading your money across different asset classes so you're not putting all your eggs in one basket. 6. Opening your first investment account. Now that you have a better understanding of what to invest in and how much to invest, it's time to open your first investment account. You could do this through a brokerage firm like Vanguard, Fidelity, or Charles Schwab, or through an app like Robinhood or Webull. Some apps allow you to start investing with as little as $1, and many offer no-fee trading. When choosing an investment platform, look for one that aligns with your goals, offers low fees, and provides educational resources to help you grow as an investor. 7. Invest for the long term. One of the keys to successful investing is focusing on the long term. Investing is not about making quick gains. It's about consistent, steady growth over time. Don't panic when the market dips or when you see short-term volatility. The stock market goes up and down, but over the long term, it tends to rise. If you stick to your strategy, reinvest your earnings, and stay patient, you'll see your money grow over time. 8. Monitor and adjust your investments. Even after you've made your first investment, it's important to monitor your portfolio regularly. Review your investments at least once a quarter to see how they're performing and whether they still align with your goals. As your financial situation or investment knowledge improves, you may want to adjust your portfolio. For example, If you've saved up more money, you might increase your risk tolerance by adding more stocks to your portfolio. Adjusting your investments ensures that you stay on track to meet your financial goals. 9. Keep learning and stay disciplined. Finally, investing is a lifelong learning process. The more you educate yourself, the better decisions you'll make. There are countless books, podcasts, and online resources that can help you deepen your investment knowledge. The key is to stay disciplined. Don't get swayed by emotions or the fear of missing out on the latest trend. Stay focused on your long-term goals and keep learning to become a smarter, more confident investor. That's it. You now have a solid foundation for starting your investment journey in 2024. Remember, investing is one of the best ways to build wealth over time, and it's never too late to begin. Start small, stay disciplined, and continue learning along the way. Thanks for watching, and if you enjoyed this video, be sure to subscribe for more tips on personal finance and investing.